Thank you, and good morning, ladies and gentlemen, and thank you for taking the time to attend the Asanko Gold presentation. I will be making some forward-looking statements during today's presentation, and please also note that all dollar amounts quoted in the presentation will be in US dollars unless otherwise stated. So for those of you not familiar with Asanko, we are a producing gold company. We operate our namesake mine called the Asanko Gold Mine. It's in Ghana, West Africa. We built this mine. We put it into commercial production in the first quarter of 2016. We've operated it now for about 3 years. Last year, the mine produced about 228,000 ounces of gold at an all-in sustaining cost of around $1,070 per ounce. Last year, the company announced a transformational deal whereby we formed a joint venture over the Asanko Gold Mine with Goldfields Inc. out of South Africa. So the Asanko Gold Mine, or the AGM, is now a 50-50 joint venture between Goldfields and Asanko, with Asanko operating it. Just in terms of a few corporate items, we do have here, we do trade on both the Toronto Stock Exchange and the New York Stock Exchange under the ticker AKG. Currently, about 75% of our liquidity comes here out of New York. As at the time of printing of this presentation, our market capitalization was just under 130 million. We do have a reasonably strong institutional investor base. About half the stock is held institutionally. In terms of the balance sheet, we look at the balance sheet in two ways. Firstly, the balance sheet at the joint venture level has about $30 million in cash, just over that at the end of the first quarter, cash and immediately convertible receivables as well as bullion. So we're in good shape there with no debt. Corporately, we had $9 million in treasury when we ended the quarter. We're not burning a lot of cash at the corporate level right now. We are paid a management fee of $6 million a year from the JV to run the operations. So very low burn rate, but we do anticipate topping the treasury up here in the second half of the year. There's one final tranche of payment due from Goldfields of an additional $20 million as part of the 50-50 joint venture agreement. It is to come in before December 31st. So we anticipate ending the year corporately with between $25 and $26 million in cash and no debt on the balance sheet. In terms of the assets, the Asanko Gold Mine Complex, you can see the concessions here on the right-hand side shaded in blue, really consist of a number of open pits. The bulk of our resources, however, are hosted anchored by, if you like, the two pits called the Sassi and Nkran, one being the northernmost pit on the concessions there, one being the southernmost. Nkran is where the southernmost pit is where the bulk of the ore has come over the last 3 years to feed our processing plant, which we've located immediately adjacent to the Nkran pit. You can see it there in the red dot on the map. We have also been undertaking over the last 18 months a pretty significant capital spend in terms of preparing to mine phase 2 of the Nkran pit. It was a major pushback that's taken about 18 months to complete. We spent over $80 million in waste stripping there. That's all been funded out of cash flow from operations. In addition, we have now opened up our second major pit called the Sassi, which is on the northern part of the concessions here. You can see in the pie charts over half of our reserves and resources are hosted in Sassi. We have commenced trial mining there in January, and we've subsequently ramped up those mining operations to the point where we're now feeding the mill with between 25 and 40%, depending on the day, of oxide ore from the Sassi pit. We're currently hauling that ore down the blue line there as a haul road. It's about 20 miles or 30 kilometers from the pit to the processing plant. In terms of that plant, it is a fairly straightforward metallurgical operation. We have a crushing circuit followed by a SAG ball mill combination. We follow that up with gravity gold recovery. About 40% of the gold here is recovered in Nelson concentrators after the milling circuit. The rest of it is recovered in a fairly standard CIL circuit. So you can see here, we designed originally the processing plant to treat 3 million tons per year of fresh ore from the Nkran pit. Over the first 2 years of operations, we invested between $25 and $30 million in capital to expand that milling operations from 3 million tons per year to 5 million tons per year. You can see the ramp-up curve on the top right graph there. Initially, we commissioning in 2016, last year producing just over 5 million tons per year. We expect more of the same in 2019, anticipating 5.4 million tons processed. In the bottom graph, you can see in conjunction with that, the ramp-up of gold recovery. We were able to continue to produce gold through all of that modifications to the circuit and the expansion. We've now producing, last year, as I said, 228,000 ounces. We expect this year to produce between 225,000 and 245,000 ounces at an all-in sustaining cost of $1,040 to $1,060 an ounce. Whilst we've been doing that ramp up, metallurgy has stayed consistent. Our average gold recoveries are between 93 and 94%, and that's been consistent since the first day we switched these mills on. This in terms of outlook for both this year and for next year. Q1, we did produce just over 60,000 ounces of gold. That was our third consecutive quarter of 60,000 ounces of production. So we are on track to meet our guidance. Q2, we're expecting more of the same. We've had 2 good months at the mine site in April and May. Where we've been really focused here over the last 2 years as we've been doing this ramp up and investing capital in the mill expansion, in opening up Asasi, in performing this major waste pushback at the Nkran pit, is all on quality. We've been really trying to focus on consistently being able to deliver ounces into our guidance. And I think we now have that stabilized, and the mine is running very well with almost a year now of consistent production. So we're really at an inflection point in the mine where we're shifting our focus from quality, things like grade control drilling, our systems, our processes, delivering into our guidance quarter after quarter, to now focus on costs. So you can see here our all-in sustaining costs. Guidance is $1,040 to $1,060. The first quarter, sorry, it's not on the slide here, was $1,123, slightly above that guidance. The reason for that is although we capitalize the stripping that we're doing in the Nkran pit, we do bring it back into the all-in sustaining costs off the cash flow statement. So it does have a fairly significant impact on all-in sustaining costs. As that stripping completes itself here in the third quarter, ramps down in August, we are going to see those all-in sustaining costs come down below $1,000 an ounce to the low 900s, and we're anticipating meeting our guidance this year. So where we're really focused in terms of also driving the cost down is also on minimizing the capital spend going forward. We've come through a big capital investment period. We're expecting that we're going to only spend, you can see here, a relatively minor amount of sustaining and development capital over the next 18 months. And that'll allow us to start to build cash on the balance sheet, generate cash flow from the operations, and to ideally return some of that cash flow to our shareholders and to our joint venture partner. And we'd anticipate looking at options for that. Our current valuation levels, I think a share buyback makes sense, and we'll also look at opportunities for paying dividends come 2020. Just very quickly on the exploration side of things, we do have a very large land package here with over 20,000 hectares. We are looking at exploring that. Predominantly the strategy here is revolved around the main target that we're chasing is called Tantacrum, which is in one of the yellow boxes on the bottom left of that chart. The concept here is not to build ounces at the end of what's already a substantial mine life. The concept is we believe we've got another multi-million ounce discovery at Tantacrum, which we've been drilling. You can see the results since Q1. We're expecting that we can actually bring this into production in the near term. It is on a mining lease already. We're undergoing the infill drilling program in the second half of this year, and we're hoping to be in here mining in Q1 2021. And the reason for that is it'll just give us a lot more flexibility in how we run our mining operations. It'll be a nice complement to the Nkran pit and to the Asasi pit. And with that third pit, it'll give us the flexibility to allow us to defer any a third cut at the Nkran pit in terms of major capital stripping. I'll skip over that. So just to conclude for today, what you can expect from the company over the next 18 months is continuing to deliver on our quarter-over-quarter guidance, hitting that 60,000 ounce target, driving all-in sustaining costs down to create a margin, and building cash on what's already a strong balance sheet, which should put us in a good position to be able to return some of that cash to our shareholders in the form of either a share buyback or a dividend come 2020. So thank you very much for your interest in Asanko.